Hello everyone, my name is Dave Partner, and in this video tutorial series we will be looking through blockchain and cryptocurrencies. And the reason I'm making this video is that this is a completely new technology, but then the problem is solving is so important that this technology is basically what will take over the rest of our future. And a whole lot of billionaires will have been made. People have become millionaires, multimillionaires, and billionaires within the last 8 years because this technology is just 8 years old. But the problem is that if you search through the internet, you won't just get a coordinated explanation and in-depth general overview explanation of what this really is. I bet if you're watching this video, you might still be confused about what actually is blockchain, what is cryptocurrency, what is Bitcoin, what is Ethereum, how do they all relate? So that is why I'm making this video. I want to take this terminology step by step and show you through. So this is a theoretical course, but then at the end of the day, you will walk off this course knowing a whole lot about cryptocurrencies and blockchains. The blockchain technology was proposed in the 1990s, but it was finally built in 2009. And people that invested then, if you invested 2 cents into Bitcoin in 2009, by 2017 that 2 cents would have worth $6,000. So that is how many people who invested $1,000, $10,000 in 2010 have become mega millionaires today. And today, as we're speaking, people are selling all their properties. If you Google the internet, you see people selling their whole properties just to buy Bitcoin because people are staking a lot. The rest of the world has not caught up to what Bitcoin really is, to what cryptocurrencies are, and what blockchains are. The rest of the world has not caught up. So if you're watching this video in between 2017, 18, and probably 19, you are among the first people to catch on. And you have a big opportunity if you're among the first people. Remember when the internet first showed up in the 90s, the people that started something, an internet-based business, then have become multi-millionaires now. So let us check. The first person is Elon Musk. He started X2 in 1994, between 1994 and 1996, and today that made him a lot of money. He eventually moved into PayPal, and from then on, he has started SpaceX, he has started Tesla, he has started the Boring Company, a whole lot of companies. He is so rich now because when he was young, at the age of 24, he leveraged the power of the internet because the internet was a new technology then. Now that was around the time that Amazon started, and that was around the time that Google started, Yahoo started, Facebook started a little later on. But by the time Facebook was starting, people didn't understand what social networking was. So this is at the same time, we're at the same kind of time right now when the blockchain and cryptocurrencies are still like 8 years old. It's not even up to 10 years, and the rest of the world has not caught up. So there are about 17 million people who have created cryptocurrency accounts, and the whole world is about 7.6 billion people. So as you can see, this is the right time. If you're even investing now, you might be regretting that you didn't invest in 2009 when Bitcoin was worth 2 cents. Right now, it's still very early. If you invest now that Bitcoin is worth $6,000, it is still very early because by this time next year in 2018, it is estimated that Bitcoin might spiral up to $20,000. But however, this video tutorial is not just about Bitcoin. It's just going to show you what Bitcoin is, but it's also about blockchain. Blockchain is the technology that on which Bitcoin is built on. And not just Bitcoin, all these other all these other cryptocurrencies. The technology on which it is built on can handle other things, more than just cryptocurrency trading and stuff. The technology can do a whole lot of things. For instance, it can help, or it can be used in prevention of crime, can be used in real estate, can be used in like they're using it right now in sharing computing processing power. Alright, so this is a new technology. People are building stuff off it. So if you're watching this video, you are doing the right thing. I want you to sit down, sit back, and let me take you through this ride and by the end of this video you will understand everything about blockchains and cryptocurrencies and Ethereum and Bitcoin and mining and how they all relate to each other. So thank you very much. See you in the next video, and let's go ahead. So what exactly is a blockchain? To understand blockchains, we need to step back a little so we can build up a momentum before we get to blockchains, so that by the time we explain blockchains, it is super easy to understand. Now, a transaction is an interaction between the user and the system as prepared by whoever built the system. For example, in social media like Facebook, a good example of a transaction is a like. When a user shares a comment or a post, and when a user comments. In Twitter, it has to be when a user tweets, they have made a transaction, or when they retweet. In GitHub, you have push, pull, merge, and a whole lot of things, transactions users can do on GitHub. In Bitcoin, users basically send money. So now we understand or have an idea of what a transaction is. Let us look at what a smart contract is. A smart contract is also known as a self-executing contract. A blockchain contract or digital contract is also known as crypto contract. So, but generally it is known as a smart contract. It was first described by somebody called Nick Szabo in 1996. Nick Szabo is a computer scientist, and when they were theorizing what a blockchain would be, they just called it a decentralized system. They were theorizing it, and he figured out that if there is a decentralized system, it will need something called smart contracts. Now, a smart contract is a computer program, basically a software, a block of code written by somebody. It directly controls the transfer of digital currencies or assets between parties under certain conditions. Smart contracts can only define the rules and penalties around an agreement in the same way that a traditional contract does, but also automatically enforces those obligations. So generally, I'm going to break this down, all this grammar, I'll break it down so you understand it straight up. Now, let us picture a system where I am betting against Trump that it will rain tomorrow. So I and Trump have a bet that it will rain tomorrow, and we both stake $50 to it. Now, this is supposed to be a transaction, but then the transaction could go either way, depending on who wins the bet. So, it's not a regular transaction that just goes straight up. You know, when you make a regular transaction, it kind of goes straight up and Trump receives an alert. But in a transaction, certain conditions has to fulfill for the transaction to go through. Otherwise, it has to go back to whoever initiated the transaction. So we have two participants in this transaction, and then there's an amount of money or currency that is in it. So we have $50, for instance. But if this was a blockchain wouldn't use a fiat currency. A fiat currency is a currency approved by a legal government. For instance, a good example of a fiat currency, that is FIAT currency, is US dollars, Canadian dollars, Euro, pounds, Naira, and Japanese yen, and so on and so forth. So these things are fiat currencies. But then blockchains use cryptocurrencies. They create their own currency. You understand? So in this case, this would be a cryptocurrency, but I just used dollars so that you understand. Now the second participant is Trump, and then the body of the contract, this is a transaction. The body of the transaction contains the details of the smart contract. So, and this is an instruction that must fulfill for the transaction to go through. So for me, I'm betting that it will rain tomorrow, and Trump is betting that it won't rain. So if it rains tomorrow, I get the money. But if it doesn't, Trump will get the money. And so let's say tomorrow, this smart contract will consult the weather API, and if the weather shows that it rained tomorrow, automatically Dave will get the money. But then if it doesn't rain, Trump will get it. So tomorrow shows up, and a heavy downpour occurs, and a heavy rain occurs and sweeps up everywhere, and I get my money. That is a smart contract. Another application of this is when an employer is trying to recruit an employee and wants to make sure that the employee delivers the product or meets up deadlines before a payment goes through. And on the employee's part, they don't really trust that the employer will pay. You understand? And the employer's part, the employer does not trust that the employee will deliver. So what they do is that the employer puts the money in an escrow account. So this is basically functioning. Smart contract is basically functioning like an escrow. You understand? So the employer pays the money into the smart contract. The smart contract holds the coins. And once the employee delivers, the money will go to the employee. But if the employee doesn't deliver within so and so time of the year, the money will go back to the employer. So that is a smart contract. So if anybody asks you any day what a smart contract is, you should be able to explain it simply and in a very clear and straightforward manner. But you should always understand that a smart contract is basically a software program, basically if and else statements that somebody wrote. You understand? So thank you very much. See you in the next video as we go in depth into really understanding what this blockchain is all about. Thank you. See you. So what exactly is blockchain? In 2008, a new era in the history of the technology of the world was kicked off when a strange person, I wouldn't say a man because nobody knows who this guy really is. So a strange person called by the name Satoshi Nakamoto published a white paper and explained what a blockchain would look like. He also explained what a cryptocurrency would look like. So we'll briefly see that blockchain. The links to these are in this slide. So if you're checking the description of this video, you will see the link to the white paper. So but I'll show you now. Before I do that, I want to slide back a little. So you see that the slide I have, I'll put a link to the slide in the first video, in the description of the first video in this series. You will see the link to this slide so that you can gain access to some of these links. I have resources here so you can read up more on some of the things I'm explaining. The way I'm explaining it is in such a way that even a non-programmer will understand it perfectly well. So, but if you're a programmer or you're curious enough, you can just go in and read up more on some of the topics I'm covering. So this Satoshi Nakamoto, this is a pseudonym because nobody really knows this guy. But obviously, whoever this person is, he is very, very rich by now because he was one of the persons, he was the person that kicked off this cryptocurrency and blockchain revolution. So a blockchain is simply a block of transactions chained together in chronological order. You understand? That is in the order in which they happened. So let's look at a typical example. Here's the first transaction. Dave sends $5 to Emily at 5 p.m. The reason the time is here is because each block contains the time the transaction was made and the order. So the second transaction contains the number 2 and Dave sends $5 to John at 5:01 p.m. So it turns out that this second transaction will contain details of the first. And then the third transaction, John sends $32 to Cain at 5:03 p.m. and the fourth transaction happens exactly at John sends $3 to Cain at 5:03 p.m. As you can see, there are two identical transactions. The last two seem identical. The only difference is in the transaction number, which is 3 and 4, and the amount of money John sent. But if you look at the time, you see that the time is the same. So what the blockchain does, remember I told you that blockchain is chronological and the transactions are chained chronologically. So if the blockchain wants to figure out which of these is authentic, it will figure out which of the transactions went first. You understand? This doesn't appear to make much meaning unless you actually relate it to a coin. Imagine that you have, this is digital coin. In physical coins, imagine you have physical coins and you want to give let's say 2 coins to Emily, and you want to give the same 2 coins to John. It's not possible because physically, if you hand over 2 coins to Emily, you can no longer hand over the exact same 2 coins to John. You understand? You have to give John another pair of 2 coins. But digitally, it's possible for somebody to try to trick the system by sending the exact same coins or currency to 2 different people. You understand? So the way the blockchain prevents this is to make sure that for each transaction, it wants to make sure that each transaction contains a history, or each block of transactions contain a history of the previous blocks. So if I should check the block of transaction that contains John sends $32 to Kane, I should see a history of all the ones that have happened behind it. So if there are any two conflicting transactions, I'll simply check the time to know which one happened first, or the order in which they happened. So the blockchain will always choose the block that happened first. You understand? So if somebody tried to trick the system, it wouldn't be possible. So but we'll go in depth into blocks and transactions as we go down. So now look at these two systems. A blockchain is a decentralized system, but most of the systems we have in the world today, most of the technologies, everything is centralized. For instance, this is you and this is your bank. The same bank serves this person and this person and this person. So what if a bank gets robbed? How do you recover your money? Everybody's money gets lost. But then forget it. What if a bank gets hacked? Everybody's money gets lost. So what if a bank enters into trouble, some financial trouble, like what happened in 2008? It was a financial trouble that happened to banks in 2008 that caused Satoshi Nakamoto to come up with this idea. You understand? So the banks were in trouble, and many people were committing suicide because they were losing a lot of money, and Satoshi had to come up with it. I think what really happened that time was that the bank took people's money and invested in real estate, and the price of the real estate in the US fell so low that the bank literally lost all the money they invested. So they didn't have money enough to pay people back. So literally, you have money in the bank, but if you go to the bank to withdraw, you won't be able to withdraw because the bank doesn't have money to give you. So people ran into all sorts of financial problems. So that was why they came up with this distributed system. All right. So if you look at a decentralized system, this is what a blockchain looks like. And as you can see, these are nodes in the system. Look at this as a computer, and each of these computers contain 100% of the code for the blockchain. So they just contain copies of the blockchain software, and they contain the full database of all transactions that has ever happened. So if somebody were to hack this particular node, all these other ones haven't been hacked. So it doesn't make sense for anybody to try and hack all the thousands or millions of computers on this network, because to bring down the network, you have to hack everything. So it doesn't make sense to hack it. So with this way, they were able to overcome the problem of the traditional banking system. All right, I put links so that you can read up more on how these things happen. Now, what is a distributed processing? What is distributed processing? A node, or basically a computer performing a transaction on a network, has to broadcast the transaction to all nodes in the network. So let's go back. Let's say that this is Dave and this is Trump, and Dave wants to send some money to Trump. Now Dave sends the information to this node. This node takes a copy of this transaction and broadcasts it to all these nodes. So each of these nodes would have a copy of this transaction. Now what does the nodes have to do? So each of these computers will have to perform a small math problem. They have to do some calculations to check whether the transaction is valid. Basically, the calculation they're checking is to check the chronological order of the transaction to make sure that it's valid. If each transaction in a blockchain is immutable. You know what is immutable? For instance, if Dave sends $5 to Emily and sends $5 to John, Dave cannot come back and edit this particular transaction. He can't come and change this to $15 or change the time to 5:12 p.m. Once this transaction is created, it can no longer be edited. You understand? So this node broadcasts a copy of each of these transactions to all nodes. So each of the nodes will have to go back and cross-check that this node actually, the tree it contains is the same tree of all the transactions. Once the block of transaction is verified, the transaction will go through. Now, each node in the network has to solve a math problem to verify that the transaction is valid. Once verified, the node has to vote yes. At least 51% of the nodes on the network has to vote yes for the transaction to go through. Nodes that verify these transactions are called miners. So let's see a practical example. So this node 1 gets a copy of the transaction. He broadcasts it to node 2 and node 5 and node 4 and node 3. So each of these nodes have to do a calculation to verify that the transaction is correct. So what happens is that the first node to actually validate this transaction gets a coins. So the first computer that verifies this gets paid. That is called mining. So when someone tells you that they are mining cryptocurrency, it means that they have a physical computer in their house that tracks transactions and verifies them, and they make money when they are the first to verify. If this is the first to verify, this guy gets paid. Then all of these guys just have to submit a copy of their verification or their approval. And if 51% of the nodes on this network verify this transaction, it goes through. So in real life, in cryptocurrencies, if Dave sends money to Trump, it will take up to 10 to 15 minutes for it to go through. But with recent advancements in technology, it takes about 3 to 5 minutes in some blockchains for the transaction to go through. But the thing that happens within that 3 to 5 minutes is that all the nodes in the world try to vote to make sure that it is correct. Once it's above 51% of the nodes, the transaction will be authorized by the blockchain software and it will go through. So a blockchain must always have coins inbuilt because of the human factor needing incentives to work. So if there is no coin, if this guy wouldn't get paid for being the first, these are humans that owns this computer. Nobody wants to spend $3,000 to $5,000 buying a computer that will verify a transaction and not get nothing from it. So the reason there is a coin or cryptocurrency on top of every blockchain is so that the blockchain can pay people doing the verification of the mining. So at this point, I want to stop this video and we will quickly move over to the next videos where we would see what mining is. And we'll also see the white paper by Satoshi Nakamoto in 2008. And we'll take a quick glance at the white paper, and I'll put a link to that white paper so you can go ahead later on to read it up. Alright, it's just about 8 to 13 pages and reading it will change your life. See you in the next video where we'll continue with this in-depth explanation of blockchains and cryptocurrencies. So when Bitcoin was first published in 2009, when it was first produced in 2009, and people really didn't understand the difference between the Bitcoin itself, the currency, and the blockchain it rested on. So, but as soon as people figured out what blockchains were, they figured out that they could make money from mining Bitcoin. Then mining Bitcoin wasn't really profitable then because there weren't many people buying up Bitcoins. So, but as the time grew up, mining Bitcoin became much more super profitable for people that started early. But then the thing is that at this point in time, it's no longer profitable to mine Bitcoin. You could mine other currencies, but Bitcoin is no longer profitable because so many people have created accounts with Bitcoins and so many miners have joined. So it's becoming increasingly more and more complex to do the math problem. So you can no longer mine Bitcoin using this kind of machine. So look at this. This is a mining rig. Is called a mining rig, and what it does is verify transactions by solving math problems, minting new coins. So this has a connection to the internet. As you can see, this is a motherboard and these are processors. So when Bitcoin first started, the calculation wasn't much, so people could use their laptops at home to mine Bitcoin. But as the calculations increased, as more and more people joined Bitcoin and started making more and more transactions, there became issues, which is that you have to need a bigger and bigger processors and mining rig to mine Bitcoin. So, but if we step back a little, we will realize that actually, if we look at this diagram, this is a very oversimplified version of what actually happens. In real life, millions of people are making transactions and millions of nodes are sending a copy, broadcasting a copy of the transactions to all other nodes. Instantaneously, these things are happening in seconds, split seconds. So what happens at the end of the day is that transactions have to queue. You understand? So you can have 5, 10, 15, 1,000 transactions queuing up. So the transactions are grouped into blocks. So as transactions are queued up, they are grouped into blocks, and those blocks are chained together. Each block has an ID and the time in which it came in. So those blocks are what are called blockchains. The way they are chained chronologically, the ones that came later will be after the ones that came first. So this node will take a full block and try to verify all the transactions inside that block. And this other one will take the same thing. So they are actually collecting blocks, not just individual transactions. So what happens after this guy, 51% of the nodes on this network verify the transactions, that block that was verified will be added to the new block. So each of these 51% will get a new copy of that block, and they'll have to update their database with the new block, so that everybody will now know that if there were 50 blocks before, there will now be 51. If a new block is verified, there will now be 52 blocks. So as you can see, the complexity is increasing, and the amount of work to verify a transaction starts increasing. So you can no longer use a small rig like this for Bitcoin, but there are coins you could use it for. You could use it for Dogecoin, Dash. You could use it for Dashcoin. You could use it for Litecoin, Feathercoin. All these ones make profit. But for Bitcoin, it's no longer profitable for an individual. I'll show you the size of rigs that are used for Bitcoin nowadays. All right. So a mining rig is a special computer used for mining. Example this, and someone who owns a mining rig is a miner. You understand? Or basically, the computer itself can be called a miner. Okay. Anyone can own a mining rig. If you have between $1,000 to $5,000, you could own a mining rig. Then every cryptocurrency has a limit of how many coins can be mined. You know, every time this node becomes the first to verify a transaction, a new coin will be created and be paid to this node. So the software, the blockchain software, creates a new coin and pays this guy for as a reward for being the first to validate that block. You understand? So that is how miners make their money. So they said so far about 16 to 17 million bitcoins have been created, but then the highest that can be created is 21 million. They said once it's 21 million, they will have to rewrite the Bitcoin blockchain protocol to accommodate much larger Bitcoin. So every coin has a maximum amount that is enshrined in it or encoded in it by the original people that coded the coin or the cryptocurrency or blockchain as the maximum that can ever be mined. You understand? Now there are two types of mining. They are called proof of work and proof of stake. So this is an example of another mine. As you can see, this is much more bigger, and this is a fan. So basically you need fans behind each of these guys, and you need internet connection over 2 Mbps. Your internet connection has to be fast, and you need fan because these things are doing a lot of calculation. If you try this mining with your laptop, sorry, your laptop is going to crash. So you need a big system like this, you understand, to do your mining. Now, is mining really profitable? But before then, let us look at what proof of work is. Proof of work is when this guy does mining, one of these rigs does mining, they have to send a proof that they have actually done the calculation. That is proof of work. But blockchains like Ethereum are moving to proof of stake. That is a stake that they own in the cryptocurrency. They have to prove that they own some cryptocurrency, sort of. So you need to understand at this point that this is a new concept that has not been implemented. Proof of stake has not been implemented yet. So nobody really knows how they will end up implementing it, but it has to do away with all these physical mining rigs. So very soon, all these physical mining rigs will be gone forever. Now, it's no longer profitable for individuals to mine Bitcoin, only large establishments with lots of mining rigs. The mathematical problem a rig has to do to mine Bitcoin has become so large that small rigs can no longer handle it. So let me show you an example of a Bitcoin mining rig. As you can see, this is a full room, a full hall with lots and lots and lots and lots and lots and lots of rigs stacked up in rows and columns. So this is what it takes to mine Bitcoin these days. But then you can mine other coins with small mining rigs. So how much can you really make per day if you're mining other coins with small mining rig? If you invest $1,000 into buying and setting up your own rig, you will make around $1 to $10 on the average. But if you invest something like $3,000 to $5,000 to buy bigger, more quality, high quality, more sophisticated rigs, you make about $1 to $50 daily. So miners make around this amount daily, and it costs them this amount. So you can do your mathematics to figure out how long it will take them to recoup their money. You understand? So, but mining is not really where the real money is in cryptocurrency. Apart from the people that started mining Bitcoin early on when it started, mining is not really where the money is. The money is in trading the Bitcoin cryptocurrency. Anybody can trade it. You just pass money from your credit card into your online account and you start trading Bitcoin or any of the 1000 altcoins. That is where the real fast money is. That's why this system is making everybody go gaga. But for mining, as you can see, the profits is just for the long haul. You want to stay like 12 to 18 months before you start recovering anything meaningful. All right. So see you in the next video where we'll go in depth into other things. I have some resources that you could check on mining. As I usually say, you have to check the first video in this series, the description, and you will see the links to this slide I use, so you can get the links to all this. You understand? See you in the next video. So what is cryptocurrency and how is it different from fiat currencies? I explained at the beginning of this series that fiat currencies are currencies that are legally authorized by government. For instance, the currency that each country uses. In Nigeria, the good country of Nigeria where I come from, we use Naira. In the US, they use US dollars, and you have euro, pounds, and a whole lot more currencies. Those are fiat currencies. You understand? That is FIAT currencies. Now, cryptocurrencies it's a form of digital currency designed to leverage the power of blockchains to be secure, trustless, and anonymous. So there are different types of digital currencies, but this one is crypto. It's encrypted. It has to do with a lot of digital encryption. For instance, in PayPal, when you trade dollars in PayPal, you actually trade in fiat currency. That is a number in PayPal or your PayPal account that has a value in the real world. So if you log into your PayPal account and you see $700, that $700 there is just a figure, but in the real world it has a value because it's tied to the fiat currency. Now, cryptocurrency is just like that, but it's on its own currency value. So a cryptocurrency could be Bitcoin, it could be Ethereum, it could be Litecoin. As at now, there are about 1,000 different cryptocurrencies, and I have the programming ability to create one. So if you want me to create for you, you need to chat me up and then let's talk business. But I want to let you know that teams can build cryptocurrencies. You understand? And a lot of people are making lots and millions of money from building it. So it's a form of digital currency, but this cryptocurrency must live on a blockchain. You understand? It doesn't just run anywhere. It lives on a blockchain. And like I explained earlier, they can't build a blockchain without building a cryptocurrency into it. Maybe in the future, they'll figure out how to build a blockchain without cryptocurrency. But for now, a cryptocurrency is what makes the blockchain interesting to use for people. And if there is no incentive to use the platform, people won't use it. So the cryptocurrency is the incentive. So cryptocurrencies, like I said, are the reasons why blockchains work. Bitcoin is the very first cryptocurrency. It was proposed by Satoshi Nakamoto. Now, what people now did was, as more and more people started buying Bitcoin, people realized that Bitcoin became more and more expensive because the demand shot up. As it became more and more expensive, it became more and more difficult for people to buy one full Bitcoin. As at 2017, one Bitcoin is worth $6,000. So it's difficult for people to just cough out $6,000 and buy one Bitcoin. So people are now buying decimals, fractions of Bitcoin. So if you divide one Bitcoin by 1 million, you get something called a Satoshi. So the people that built Bitcoin kind of immortalized the name of the guy that proposed it. The unknown guy, because nobody knows who Satoshi is really. So, but they decided to immortalize him and give a 1 millionth fraction of Bitcoin is called a Satoshi. So people are actually trading those. So if you divide $6,000 by 1 million, that is the worth of a Satoshi. And as the value of Bitcoins continues increasing, the value of a Satoshi continues increasing. And then they are saying that if they get to a point that once Satoshi becomes so expensive, they might have to divide it by 1 million again. You understand? So if you've not invested in Bitcoin and cryptocurrencies at this point, I think this is the best point to invest. But this video is not about investing in cryptocurrencies. And remember, it's just like stock market. You could invest and lose all your money, and you can invest and make a whole lot of money like many people have made. And in 2018, many more people will make a whole lot of money from it. So especially people who are building their own currencies. So if you want me to build your currency, we can talk about it. I'll help you build it. Otherwise, you can just do your trading. Any individual anywhere in the world that has a credit card can just start trading currencies. So my next course is on the tips and tricks on how to trade cryptocurrencies, and I want you to subscribe to that course so that you will learn. All other cryptocurrencies are called alternative coins. So Bitcoin is the main cryptocurrency and is the most expensive. All other coins are called altcoins. So anytime you hear about altcoins, you should know that they are talking about all other currencies, cryptocurrencies that are not Bitcoin. So far, nearly 1,000 has been made so far. So let me see you in the next video, where we'll go into just a brief explanation of Bitcoin and Ethereum. But before then, the Bitcoin with a capital B is the blockchain on which Bitcoin works. Bitcoin with a small b is actually the currency that works on that blockchain itself. Now, in 2009, when they first published released Bitcoin, one Bitcoin was worth 2 cents. So if you had $1,000 then, you would have bought a whole bunch of Bitcoin, and honestly, at that time, it would have been so useless. But then in 2017, January, one Bitcoin was now worth $700. The same year, one Bitcoin is now worth $6,000 by October the same year. Now, imagine what one Bitcoin was worth by October in 2018. If you're watching this before then, you will observe that it would have, by current estimates, it would have blown to something much huger. So at any point you're watching this video, you want to see my next video on cryptocurrency trading so you can start investing instantly, because I don't know what investment you can do that will move your 2 cents to $6,000 or your $700 to $6,000 within the same year. You understand? So I'll see you in the next video where we explain what Ethereum is, and then we'll see the resources for the cryptocurrencies. All right, so thank you very much. See you in the next video. So I promised to bring you this white paper. If you go to your browser and type bitcoin.org/bitcoin.pdf, you will see this white paper that started the whole Bitcoin blockchain revolution. Was published in 2008 by somebody that called himself Satoshi Nakamoto, obviously a Japanese name. So if you run through, you see that he started by explaining the problem with the current banking system, and then he explained how the whole system will work, on the whole transactions will work, and explained a whole lot of things. But then it is very legible, and you can just get this done in 10 minutes. You would have read a whole lot and understood what this is all about. So anybody that is doing anything, if you really want to understand how this whole revolution started, you should read this paper that I'm scrolling through. As you can see, it's very small, and then we are at the end of it, and there is no calculation, as you can see. But although they try to do 1 or 2 calculations here, but if you read the writing, there is not much calculation there. It's just a demonstration of what it is, and as you can see, it is only 8 pages long. All right, and then there are references you could check out that he used before coming up with this system. So this is the white paper that sparked off the Bitcoin revolution and the blockchain cryptocurrency revolution. After publishing this in 2008, in 2009 Bitcoin was built. That was like a year afterwards. All right, so the next thing we're going to check out is Ethereum. So Ethereum is essentially an improvement in a way on Bitcoin. So let us look at it. In 2000 and in the early days of Bitcoin, that's like 2010, 11, 12, there was this guy called Vitalik Buterin. He was 19 years old in 2013, and he was a blogger. From what I read, he was just blogging and about Bitcoin and giving up updates on Bitcoin. So he figured out that the Bitcoin system wasn't robust enough. For instance, it doesn't allow other people to create their own currencies and their own smart contracts. So he wrote to the Bitcoin team and asked them to improve the Bitcoin system to make it possible for any random person to build their own currency or smart contracts without having to build an entire blockchain, you know. So the Bitcoin team refused. This is what I read on the internet, so you could Google to read yours, but I'll put links after this slide. So the Bitcoin team refused, saying that it would cost them much work to rebrand the whole system. So this 19-year-old wrote his own white paper on Ethereum. You can Google Ethereum white paper. And then he got a lot of people investments, and then he started something he called a blockchain he called Ethereum. So after building Ethereum, he built something called Ether inside it. The Ether is the currency itself, just like the small letter Bitcoin is the currency inside the Bitcoin blockchain. So the Ether is the cryptocurrency inbuilt into the Ethereum blockchain. But these days, some people just call the Ether the Ethereum. You understand? So whenever you hear Ethereum, the person might just be referring to the blockchain itself or the cryptocurrency. Most people just don't care about the blockchain. They're just talking about the cryptocurrency. So this guy built this Ethereum platform and made it possible for anybody to just log in and create their own, build whatever smart contracts they want to build on the Ethereum platform. He proposed it in 2013, and by 2015, he was able to build it. Ethereum is basically, in that 2015 that they launched Ethereum, it was worth $1. In 2017, Ethereum is now worth $320. October 2017, that's like 2 years later, was worth $320. So if you invested $1,000 in 2013 in Ethereum, by 2017, that is 2 years later, you would have $320,000. You understand? That is why this field is so amazing. And who knows what price Ethereum will be next year. All right. So now what we're looking at is that so many coins and platforms and smart contracts are being created on Ethereum. So Ethereum is basically what I'll call the platform of the future. It's like the future. That's why I called it an improvement on Bitcoin. So, which means Ethereum is a blockchain that has its own Turing complete programming language, because for you to create your own coins or smart contracts, you will need to actually code it, write a programming language. So they built a programming language that is Turing complete. If you're a computer science student or graduate, you would know what Turing complete is. But Turing complete simply means that the programming language has the same power as any other programming language on earth. So the programming language you find in Ethereum is of the same power with any other programming language like JavaScript, like PHP, like Python that you know. You understand? And to build on the Ethereum platform, you will need to have an Ether. So if I want to go and build my coin and stuff like that, I will need to buy Ether. So that's how they make their own gains. You understand? All right. So let us look at cryptocurrency resources. You see, this is a link to the white paper, and if you want to read more about cryptocurrencies, and this is everything about Ethereum that you need to know, and you can Google to find more. Now, what is decentralized organizations? I would like to talk more on decentralized organizations in the next slide, because you'll be wondering, why is it that there is still an organization that the people that built the blockchain themselves, if they are still there, why is the blockchain called decentralized? So let us look at decentralized autonomous organizations that are called DAO in the next slide. Thank you very much. See you. So if you want to read more about cryptocurrencies, these are the links to go through. And in this video, we'll be looking at DAO. DAO is a decentralized autonomous organization. It is it was invented after the blockchain because they realized that they could actually build an organization that lives inside the blockchain. Every decision in the organization will be treated as a transaction. 51% of the human beings or the people in that organization has to vote to approve any decision. So it's unlike a traditional organizations where you have a hierarchy, where you have CEOs and the C-level organization, you have the foot soldiers and so on and so forth. In DAO, everybody is equal, so everybody gets to vote on each issue. So somebody raises an issue, people read it and ask questions, especially like in the Slack channels or discussion groups or the forums. People ask questions and the person answers it, and then if they are satisfied, they can now go and vote on whether that can be done. So many issues can be raised. For instance, the amount of money to pay developers, the amount of money to pay that will go into research, where the new office will be located, which staff to hire, and a whole lot of things can go into can be issues raised by the DAO. And the first members of the DAO are usually the people that built the blockchain. But somebody would ask, what is the incentive for them to relinquish authority to the rest of the people who own stake in that company, which basically people who own coins and stuff in the blockchain? Now, when they are creating that blockchain, they reserve a lot of coins for themselves. So if the value of the coins go up, they make a whole lot of money. So controlling the organization autocratically is not one of their concerns. So they want to make sure that every single decision that is taken inside that organization is voted on by everybody that is interested in voting, probably people that have stake in that company. DAO is run through rules encoded as computer programs called smart contracts. Remember when we discussed smart contracts? So everything in DAO is was built in during the development of the blockchain. So people use the blockchain as an organization to run their institutions. So they want to make sure that everything about their blockchain is completely decentralized. So everybody you see building a blockchain, and obviously a coin too, would like to have the organization run as a DAO. And I want to let you know that apart from all these issues, there are so many variety of issues that can be raised by people. For instance, somebody was able to raise funding from DAO in like 3-4 months ago. So the person simply applied, and people asked a lot of questions in the forum. Then they went ahead and voted, and she got the funding. It's a lady that did it. So you can actually get funding from DAO or donations from DAO if you own a stake and you can raise an issue. So here are some examples of decentralized autonomous organizations, or DAO. One of them is Dash. These people have a coin. Another one is Timit. They have a coin too. This is a social network. And then this is Ethereum, the blockchain that owns the Ether. You understand? So this is a social network. You sign up, they verify you after 24 to 48 hours, and then you start posting. For each post you have, if somebody likes your post, you get a fraction of $1. Now here are some resources you could use to read up more on DAO and how to how somebody applied for funding on DAO. Like I said, the link to this resource is on the first video in this series. Just check the description, you'll see the link to the whole slide. All right. Finally, in the next video, we'll look at how everything works, and get a general overview of how everything I've explained in this course series works together. Just one video that will explain everything at a stretch. So thank you very much. See you in the next video. So this is how it works. For instance, if you've been watching all this, you could be asking yourself, where do I really start? So this is how it works. Dave Partner, which is myself, downloads a cryptocurrency wallet app and signs up on a wallet website, or signs up on a website. For instance, there's readmetano.com that is available to people, a whole lot of people. Then there is Coinbase.com and a whole lot of other wallet websites. What this wallet website does is that they keep your private key. When you create a new Bitcoin account, for instance, you have the account number you see is a very long string, like encrypted string. That is a public key. But then there's a separate secret file that only you should have a copy of. That is supposed to be sent to you, but if you created it from a wallet site, that wallet site keeps it for you. So every time you want to make a transfer, that your secret file must sign the transfer. Only you have access to that secret file. If somebody else has access, then they can pretend to be you and make transactions. And we've seen some of these wallet sites hacked in the past. Like between 2015 and 2016, some of these wallet sites were hacked where people transferred millions of dollars away. They targeted random accounts. All right, but some of them are gradually starting to improve their security. Like I told you, everything here is a new technology. It's less than 8 years old. So a whole lot of people are starting to learn how best to structure the technology. But me personally, sometimes I just prefer to have my wallet online so that I don't have to worry about keeping my keys and a whole lot of things. So just visit any of these sites. Coinbase has over 10 million accounts, 10 million people account, and Remitano, I don't know how much, but there is a lot. So just visit any of these and then sign up and start making your transactions. Once you sign up, they will create an account for you on Ethereum. Some of them have Ripple, then some of them have, all of them have Bitcoin. So now I've created my account in this wallet. I buy a Bitcoin from a Bitcoin exchange site. There are several exchange sites where you see how much you want to buy and everything. But eventually, when you want to make the transaction, you just copy the address to send the money to come back into your wallet app and make the transfer from your wallet app. This is where you make your transfer. I'll do another course on how to invest in cryptocurrency. That's when we touch things like this. But all the transfers you're making, this is where you do that. Then number 3 is they've sent 10 coins to Obama. So I want to send 10 coins, like 10 Bitcoins or 10 Ethereum to Obama. That transaction is broadcasted into the network and now pending validation by 51% of the nodes of the network. So once I send money from my Coinbase account to Obama's account, what will happen is that the transaction is broadcasted to all nodes in the network. So all nodes have to vote. They have to verify the transaction, then they vote. The first node to verify the transaction gets paid. So many transactions occur in the network at the same time. So all pending transactions are grouped together as a block. Now each block is now chained. So multiple blocks are chained together, thereby making a blockchain. You understand? Each block has a unique ID, time, and reference to the previous block. So the miner will simply take a block and see if it has the reference to the previous blocks it has is the same thing with the copy of the blockchain the miner has. Like I told you, every miner has a copy of the blockchain. Sometimes some of them are above 30 gigabytes in memory. So if you own a mining rig, you have to download 30 gigabytes of data or much more. All right. The miner that first validates the transaction in a pending block gets a few coins as reward. The coins are created newly and just as a reward to the miner. Now when the miner makes a lot of coins, they can now transfer it and get dollars in return. They will just go to their wallet account and transfer the coins they made from mining and get dollars in return. Okay, once 51% of miners verify a block, the transaction is approved. The new block gets added to the front of the blockchain. Every miner updates their blockchain record to contain the new block. It's as simple as that. I hope this just explains everything in a simple and straightforward manner. Now, if you have any questions, don't forget to drop them in the comments. If at this point you've not subscribed to my channel, please hit on the subscribe button. And if you have any question, you can chat me up. If you need my technical expertise in building anything around this technology that I explained, please hit me up on my email. So my next course is on cryptocurrency trading, a step-by-step guide to build your own wealthy future. This is where a lot of people make money, and it doesn't involve much technical expertise. You just need to know what you're doing so you make money. Otherwise, you will lose a lot of money. But then a whole lot of people have made a whole lot of money from this. So they say that the worst mistake you can make is not to invest in cryptocurrency at all. Then they said the biggest risk you can take is to invest money that you're not willing to lose. You understand? So here are some important resources to reach me and to subscribe to get my other course when I publish it. Make sure you're subscribed on my YouTube channel. I make so many programming video tutorials, so many, over 500 video tutorials that I've made on YouTube and cryptocurrency these days that will help you. So you want to join this Facebook group, Cryptocurrency Trading Strategies. I'll put the link in the description of this video and in the description of the first video in this series. Then you want to join Cryptocurrency Trading Strategies on Telegram, where I give you tips on how to trade, on which coins to buy and which to sell. And if you need to chat me up for anything, this is the link to hit me up on. So thank you very much and congratulations for completing this tutorial series. If I discover more things, I could just come and update this video series and add more videos. Otherwise, feel free to chat me up. If you have a thank you note, you could thank me, and then in the next slide I will show you my cryptocurrency account, and if you already have money in your cryptocurrency account, please send something as a thank you note. So thank you very much.